Imagine, if you will, a giant. For decades, this giant has been slumbering beneath the floorboards of the global economy. He is ancient, forged in the heart of dying stars, and his name is gold. He is not a creature of whimsy or fleeting trends. He is a creature of substance, of weight, of undeniable reality. While the world above him danced to the fast-paced, ever-changing music of digital currencies, tech stocks, and complex derivatives, the giant slept. His snores were the steady, low hum of a safe haven asset, a relic of a bygone era, according to the maestros of modern finance. They built their glass and steel castles on foundations of paper promises and algorithmic certainties, occasionally glancing down at the dusty cellar where the old giant lay chuckling at his obsolescence. He's too slow, they'd say, too heavy. He doesn't understand the new world. But they forgot one crucial thing about giants. They may sleep for a long, long time, but when they wake up, the very foundations of the world tremble. The first stirrings were subtle, almost imperceptible. It wasn't a sudden jolt, but a slow, deep intake of breath. It began in the quiet, chandeliered halls of the world's central banks, far from the frantic energy of the New York Stock Exchange. For years, these institutions, the guardians of national wealth, had been net sellers of gold, trimming their holdings in favor of U.S. Treasury bonds, the bedrock of the post-WW1 financial system. But then, around the time of the 2008 financial crisis, a quiet shift began. It started as a trickle. The People's Bank of China, the Central Bank of Russia, the Reserve Bank of India, they started buying. Not with fanfare or grand announcements, but discreetly, consistently, month after month. They were repatriating their gold, bringing it home from vaults in London and New York. They were adding to their stacks, ounce by gleaming ounce. It was the giant's first deep breath. The world, mesmerized by quantitative easing and the heroic efforts of the Federal Reserve to save the banking system, barely noticed. The financial news cycle was dominated by the lexicon of crisis and recovery, subprime mortgages, credit default swaps, bailouts, and stimulus packages. Gold saw a brief spike in interest with the flight to safety as Lehman Brothers collapsed, but as the stock market began its long decade-plus climb, the giant's initial stirring was forgotten. He seemed to settle back into his slumber, his value fluctuating but never truly challenging the new order. The second stirring was a low growl, a rumble that vibrated up through the concrete and steel of the global supply chain. The COVID-19 pandemic. The world stopped. Factories went dark, ships sat idle in ports, and governments, in a desperate bid to keep their economies from flatlining, opened the fiscal and monetary floodgates. Trillions of dollars, euros, and yen were printed out of thin air. Stimulus checks, payroll protection programs, emergency loans. It was a deluge of currency unlike anything the world had ever seen. The intention was noble, to build a bridge over the economic abyss. But the giant deep in his slumber felt this flood. It wasn't a flood of real value, but of promise, of paper. The floorboards above him were becoming waterlogged, saturated with debt. This is where our story truly begins to pivot, where the quiet accumulation by distant central banks begins to merge with the anxieties of the American household. For the average person in Peoria, Illinois, or Plano, Texas, the numbers were staggering. The national debt, already a source of low-grade political anxiety, exploded. It surpassed $20 trillion, then $25 trillion, then $30 trillion. It became a figure so large it was almost meaningless, an abstraction. But then came the consequence that everyone, from the CEO to the checkout clerk, could understand: inflation. At first, the Federal Reserve called it transitory. It was a temporary hiccup, they assured the public, a result of supply chain bottlenecks and the sudden V-shaped recovery. But the giant knew better. His growl grew louder. Transitory became persistent. The price of gasoline, of groceries, of lumber, of used cars, it all went up. $1 in 2022 bought what 94 cents bought in 2021 and what 85 cents bought just a couple of years later. The official Consumer Price Index CPI numbers, as alarming as they were, didn't even tell the full story for many families. The cost of living was running away and wages weren't keeping pace. This erosion of purchasing power is the giant's native language. Gold doesn't pay a dividend. It doesn't have a CEO or a quarterly earnings report. Its value is singular. It cannot be printed. It cannot be devalued by a government committee. Every ounce that has ever been mined still exists. It is the antithesis of the fiat currency system. While the dollar in your pocket is a promise from the government, an ounce of gold is a physical reality. It is a store of value that has outlasted every empire, every currency, every financial experiment in the last 5,000 years. As the inflation narrative shifted from transitory to entrenched, a new class of believers began to pay attention. It wasn't just the traditional gold bugs, the doomsday preppers, or the contrarian investors. It was sophisticated hedge fund managers, family offices managing generational wealth, and increasingly, ordinary people who felt the ground shifting beneath their feet. They saw their 401ks, heavily weighted in stocks and bonds, struggle as the Fed was forced to raise interest rates to combat the very inflation it had helped unleash. The traditional 60-40 portfolio, 60% stocks, 40% bonds, the bedrock of retirement planning for generations, was failing. In 2022, both stocks and bonds fell in tandem, a rare and brutal event that left many investors with nowhere to hide. Nowhere, that is, except in the cellar with the giant. The demand for physical gold began to climb. Sales of American Eagle and Canadian Maple Leaf coins surged. Premiums over the spot price, the amount extra you have to pay to get your hands on the actual physical metal versus the paper price on the screen, started to widen. This is a critical signal. It indicates that the demand for the real thing is outstripping the supply available in the labyrinthine paper markets of the COMEX and the London Bullion Market Association. It was a vote of no confidence in the paper promises that had governed the financial world for so long. Simultaneously, a third and more ominous vibration began to shake the world: geopolitics. The simmering tensions between the United States and its strategic rivals, China and Russia, broke into an open economic conflict. The weaponization of the US dollar, long the exorbitant privilege of America, became the catalyst. When Russia invaded Ukraine, the United States and its allies responded with unprecedented financial sanctions. They froze Russia's central bank assets held in Western institutions, hundreds of billions of dollars, euros, and pounds rendered inaccessible overnight. For the financial strategists in Washington and Brussels, it was a masterstroke, a way to cripple a war machine without firing a shot. But for the rest of the world, for the finance ministers in Beijing, Riyadh, Brasilia, and New Delhi, it was a terrifying wake-up call. It demonstrated that the US dollar system was not neutral financial plumbing. It was a tool of American foreign policy. Your dollar reserves, your treasury bonds, were only yours as long as you remained in the good graces of the United States. This single act did more to awaken the giant than a decade of quantitative easing. The low hum of central bank buying turned into a roar. In 2022, central banks bought a record 1,136 metric tons of gold, the most since 1967. The buying continued relentlessly through 2023 and 2024. This wasn't just diversification anymore. This was de-dollarization. Nations around the globe, many of them not adversaries, but simply cautious observers, began to question the wisdom of holding all their national savings in a currency controlled by a single powerful nation. They were seeking an alternative, an asset that was no one's liability, an asset that could be held within their own borders, immune to foreign sanctions, an asset that was liquid, universally accepted, and had been a store of wealth since the time of the pharaohs. They were turning back to gold. The giant was no longer just stirring. He was beginning to open his eyes. The world had changed. The era of low inflation, globalized supply chains, and unquestioned US financial dominance, the very conditions that had kept him asleep, was over. A new era of great power competition, persistent inflation, and deep distrust in fiat currencies was dawning. And in this new world, the old giant was not a relic. He was a necessity. His price, which had languished for years, began to climb. It broke through the psychological barrier of $2,000 an ounce, then $2,100, then $2,200. Each new high was met with surprise by mainstream analysts who kept predicting a pullback. They were still looking at the world through the old lens, analyzing interest rate differentials and ETF flows. They failed to see the bigger picture. They failed to understand the tectonic plates of the global order were shifting. They couldn't hear the footsteps of the waking giant. The story of gold's meteoric rise is often told through the lens of fear. Fear of inflation, fear of recession, fear of war. And while fear is certainly a powerful accelerant, the real, underlying story is one of a fundamental schism, a great decoupling between the world of paper and the world of physical reality. To understand the forces driving gold to unprecedented highs, we must journey into the heart of this divide, into the often opaque world of financial markets, where a single ounce of gold can exist in two very different forms, as a tangible heavy coin in your hand, and as a fleeting series of digits on a computer screen. For the average American investor, exposure to gold has traditionally come through paper instruments. You could buy an exchange-traded fund ETF like the Spider Gold Shares GLD. It's simple, liquid, and trades just like a stock. For every share of GLD you own, the fund supposedly holds a corresponding amount of physical gold in a vault in London. Or you could trade gold futures on the COMEX, a massive commodities exchange in New York. This is the realm of speculators, where you can bet on the future price of gold using immense leverage, controlling vast sums of theoretical gold with a small amount of capital. For decades, this system worked. The paper price, set by the relentless buying and selling on the COMEX and in London, was seen as the one true price of gold. The ETFs and futures markets created a vast, liquid, and easily accessible pool of gold that could absorb billions of dollars of investor demand without anyone needing to deal with the hassle of storing and securing heavy bars of metal. This system had a crucial effect. It massively increased the supply of gold, at least on paper. For every 1 physical ounce of gold sitting in a vault, traders could create 10, 50, or even 100 times that amount in paper claims through futures contracts and unallocated accounts. This immense paper leverage acted as a powerful cap on the price. Anytime real demand for physical gold started to push the price up, speculators could dump a flood of paper contracts onto the market, satisfying the demand with digital promises and pushing the price right back down. This was the financial architecture that kept the giants sedated. It was a brilliant piece of financial engineering that channeled the world's desire for a safe haven asset into a system that was ultimately controlled by a few large commercial banks, known as bullion banks. These banks could create and sell virtually unlimited amounts of paper gold, ensuring the price never got out of hand and never truly challenged the supremacy of the US dollar. But the great decoupling began when the world started to call the bluff. It started with the central banks. As we saw, nations like China, Russia, and Turkey weren't just buying gold, they were insisting on taking physical delivery. They weren't interested in a share of an ETF or a futures contract. They wanted the bars. They wanted to feel the weight, to see the serial numbers, to store the wealth within their own sovereign vaults. This simple act began to drain the physical supply from the Western-controlled vaults in London and New York that backstopped the entire paper market. Every 400-ounce bar flown to Shanghai or Istanbul was one less bar available to satisfy the potential delivery demands of 100 different paper claims. The pressure began to build. Think of it like a bank run, but in slow motion. In a traditional bank run, depositors lose faith in the bank's ability to honor their cash withdrawals and all rush to get their money out at once. In the gold market, the depositors were entire nations and they weren't panicked. They were strategic. They were methodically withdrawing the real asset that underpinned a mountain of paper derivatives. This trend then trickled down to the retail level. As inflation took hold and trust in financial institutions waned, more and more individuals in the US and Europe decided they no longer wanted a paper promise. They wanted the real thing. They started selling their ETF shares and using the proceeds to buy coins and small bars from dealers. This created a fascinating and telling divergence that the spot price of gold, the one you see on financial news channels, might be $2,300 an ounce. But if you tried to buy a 1-ounce American Eagle coin, you'd find yourself paying $2,450 or $2,500. That difference is the premium. The widening of these premiums was a blaring siren that the paper price was becoming disconnected from the reality of the physical market. The price to own the digital representation was diverging from the price to hold the actual asset. The situation was exacerbated by events on the exchanges themselves. The London Metal Exchange LME sent shockwaves through the commodity world when it was forced to halt nickel trading and cancel billions of dollars of trades in 2022 after a massive short squeeze. This event, though in a different market, shattered the illusion of infallibility. It proved that these exchanges, the supposed arbiters of fair price discovery, could and would change the rules in the middle of the game to protect their largest members. For gold investors, the question was chilling. If they could do it in nickel, what would stop them from doing it in gold or silver if a similar physical-driven short squeeze were to occur? This fear accelerated the exodus from paper to physical. Large institutional players, hedge funds, and high-net-worth individuals began to bypass the futures markets and ETFs altogether. They started using services that allowed them to buy large, allocated bars of gold and store them in private, non-bank vaults in places like Switzerland, Singapore, and even Texas. The key word here is allocated. An allocated account means you are the legal owner of specific, numbered bars. An unallocated account, which is how most institutional gold is held, simply means the bank owes you a certain amount of gold. You are an unsecured creditor. In a crisis, the difference is everything. This brings us to the numbers, the cold, hard facts that illustrate this tectonic shift. Consider the registered inventory on the COMEX. This is the specific gold set aside and certified as available for delivery to settle a futures contract. For years, the total open interest, the number of outstanding futures contracts, dwarfed the amount of registered physical gold by a factor of 100 to 1 or more. The system relied on the fact that almost no one ever took delivery. The contracts were almost always settled in cash. But as more contract holders began to stand for delivery, demanding the physical metal, the strain on this small inventory became immense. COMEX registered gold inventories began to plummet, falling from over 10 million ounces to under 3 million in a span of just a couple of years. The ratio of paper claims to physical ounces skyrocketed, at times exceeding 500 to 1. The system was becoming brittle. The giant, who represents physical reality, was withdrawing his substance from the paper world. He was starving the beast that had kept him chained. This decoupling has profound implications for the American investor in the US dollar. For decades, the dollar's status as the world's reserve currency was reinforced by the petrodollar system. Oil, the lifeblood of the global economy, was priced and traded exclusively in dollars. This created a constant artificial demand for US currency. Nations had to acquire dollars to buy energy. But this system too began to fracture. Led by China and Russia, the BRICS nations, Brazil, Russia, India, China, South Africa, and other emerging economies began to actively seek alternatives. They started conducting bilateral trade in their own currencies, bypassing the dollar entirely. Saudi Arabia, the linchpin of the petrodollar system for 50 years, began to entertain the idea of selling oil to China in yuan. The BRICS bloc expanded, welcoming nations like Saudi Arabia, the UAE, Iran, and Egypt, creating a powerful economic alliance that was openly discussing the creation of a new settlement currency, one potentially backed by a basket of commodities, including gold. This is the macro-political backdrop for gold's re-emergence. Gold is not just an inflation hedge. It is the ultimate neutral settlement asset in a world that is fracturing into competing economic blocs. It is the money of choice for central banks who no longer trust the currency of their geopolitical rivals. As the dollar's role in global trade begins to recede, even slightly, the demand for a neutral alternative like gold is set to explode. The awakening giant is not just rising against inflation, he is rising against the entire US dollar-centric financial system that has dominated the world since 1944. The paper markets, which once held him captive, are losing their grip. The price you see on your screen is becoming a lagging indicator, a shadow of the true price being paid in the physical realm, where central banks and savvy investors are quietly accumulating the real thing. The great decoupling is underway, and for those who only own the paper promise, the reckoning may be severe. The giant is walking out of the digital casino and back into the real world, and he's taking his gold with him. The journey of gold from a slumbering asset to a global headline is not a straight line. It is a story told in bursts of frantic activity, in moments where years of pent-up pressure are released in a matter of weeks or even days. We are living through one of those moments now. This is not a gentle repricing. It is a super spike, a violent upward move that leaves analysts scrambling for explanations and investors torn between the fear of missing out and the terror of buying at the top. To understand the current price explosion, we must dissect its anatomy, looking at the interlocking bones of market mechanics, human psychology, and geopolitical triggers that have fused together to create a powerful, self-reinforcing rally. The first bone in this structure is the short squeeze. As we discussed, the paper gold market has been dominated for years by immense short positions held by bullion banks. Their business model often involved suppressing the price by selling paper contracts they didn't have the physical gold to back. This works perfectly in a stable or declining market. But when a powerful, sustained buying trend emerges, driven by physical demand from central banks and investors, this short position becomes a ticking time bomb. Imagine you've promised to sell 100,000 ounces of gold at $2,200, believing the price will go down. But instead, it rockets to $2,300, then $2,400. Your paper losses are mounting exponentially. You have two choices. Either buy back your short contract at a massive loss, or acquire and deliver 100,000 ounces of physical gold, which is becoming increasingly scarce and expensive. As the price rises, more and more short sellers are forced to cover their positions by buying. This very act of buying adds more fuel to the fire, pushing the price even higher and forcing even more shorts to cover. It's a vicious cycle, a feedback loop that can lead to parabolic price moves. We are witnessing a slow-motion short squeeze on a global scale, not of a single stock like GameStop, but of the world's oldest money, orchestrated not by retail traders on Reddit, but by the world's most powerful central banks. The second bone is momentum ignition, fueled by algorithmic trading. The vast majority of trading today is not done by humans, but by high-frequency trading HFT algorithms. These algorithms are programmed to recognize patterns and trends. When a key technical level is breached, say gold's previous all-time high of around $2,070 an ounce, it triggers a cascade of pre-programmed buy orders. The algorithms don't care about fundamentals, they care about price action. A rising price triggers more buying, which triggers more buying. This is what happened as gold decisively broke through its multi-year consolidation ceiling. The move above $2,100 was the starting pistol. Billions of dollars in algorithmic and trend-following funds, which had been sitting on the sidelines, suddenly roared into the market. This explains the speed and ferocity of the move. While the fundamental buying from central banks was the steady pressure building under the market, the algorithmic buying was the explosion that sent the price vertical. It creates what traders call a vacuum on the charts, where the price shoots up through levels with very little resistance, as sellers are overwhelmed and pull their offers, waiting for a higher price. The third, and perhaps most crucial, bone is the shift in mainstream narrative. For years, the financial media and Wall Street institutions treated gold with a mixture of disdain and indifference. It was pet rock, a barbarous relic. Financial advisors rarely recommended more than a token 1 to 3% allocation. But as the price continued to make new highs day after day, week after week, this narrative began to crack. First, the tone shifted from dismissal to curiosity. Then, as the rally sustained, it shifted to grudging acceptance. Finally, it morphed into outright bullishness. Major investment banks, which had been neutral or bearish, began issuing urgent buy recommendations, setting price targets of $2,500, then $3,000, then even higher. Financial news channels, which once barely mentioned the metal, now lead their broadcasts with segments on the roaring gold market. This has a powerful psychological effect on the retail investor in America. When CNBC, the Wall Street Journal, and Goldman Sachs all start saying the same thing, people listen. This is the moment the smart money phase of the rally, led by central banks and hedge funds, transitions into the public participation phase. This is when your neighbor, your brother-in-law, the person who has never thought about gold in their life, starts asking if they should buy some. This influx of retail money, often coming in late in the cycle, provides the final, massive thrust that pushes the market into a true blow-off top. Let's look at the figures that define this phase. The flows into gold ETFs, which had been negative for months as investors rotated into physical, suddenly reversed and saw record weekly inflows. Google searches for how to buy gold spiked to their highest level in over a decade. The volume on the COMEX futures market exploded, with daily trading volumes often exceeding the entire annual global production of gold. This is the signature of a speculative frenzy. The fourth bone is the geopolitical accelerant. While the underlying economic pressures were building for years, a sudden geopolitical crisis can act like pouring gasoline on a fire. In the current environment, this could be any number of flashpoints: an escalation of the conflict in the Middle East that threatens the Strait of Hormuz and the global oil supply, a direct confrontation over Taiwan, or a sovereign debt crisis in a major Western economy like Italy or even Japan. When such a crisis hits, the normal rules of investing are suspended. It's no longer about earnings per share or interest rate projections. It's about capital preservation. It's a flight to safety on a massive scale. In these moments, gold's ancient role as a war chest and crisis hedge comes to the forefront. Unlike bonds, which carry counterparty risk, what if the government that issued them is in crisis? Or cash in a bank, what if the banking system freezes? Physical gold held in your possession or in a secure private vault is the ultimate form of financial insurance. Any major flare-up in global tensions during this already bullish phase for gold acts as a powerful catalyst, creating gap-up openings where the price jumps significantly overnight, further squeezing the shorts and feeding the speculative momentum. We can see this in the data. On days with major negative geopolitical headlines, gold often moves in the opposite direction of the stock market. While the S&P 500 might fall 2%, gold might rise 2%. This reestablishes its credentials as a true safe haven, a reputation it had lost during periods when it seemed correlated with risk assets. This renewed negative correlation makes it an essential portfolio diversifier once again, forcing asset managers who had abandoned it to rush back in, adding yet another layer of demand. The anatomy of this super spike is therefore a perfect storm. It began with a strategic, long-term draining of physical supply by the world's largest creditors, the East. This created a brittle paper market with a massive, vulnerable short position in the West. This underlying tension was then ignited by a technical breakout, amplified by armies of trading algorithms. The resulting price surge was so powerful it forced a change in the mainstream narrative, pulling in a wave of public speculation. And all of this is occurring on a stage set with the most perilous geopolitical backdrop in decades, where any new crisis can act as a powerful afterburner. For the American watching this unfold, it is a confusing and often intimidating spectacle. The giant has not just awoken, he is now smashing through the ceilings of the financial world. The old rules no longer seem to apply, and the very definition of money is being challenged in real time. The super spike is not just a rally, it is a revaluation. It is the market's way of adjusting to the new reality of a multipolar, inflationary, and unstable world. The towering price of gold, displayed in the corner of a cable news screen or on a financial website, can feel distant and abstract to the average American. It seems to belong to the world of billionaires, central banks, and shadowy hedge funds. But the awakening of the golden giant sends tremors that travel far beyond Wall Street, creating profound and often unexpected ripple effects that are reshaping the economic landscape for ordinary people, from the way they save for retirement to the very fabric of their local communities. This is the story of how the new gold rush is flowing onto Main Street. The most immediate and direct impact is on the American saver. For generations, the formula for a secure retirement was simple: work hard, save consistently, and invest in a diversified portfolio of stocks and bonds. This strategy was built on the assumption of a stable currency, and a positive real return on safe investments like government bonds. But the twin forces of persistent inflation and the Federal Reserve's response have shattered this paradigm. Consider a retiree Jane living in Scottsdale, Arizona. She did everything right. She worked for 40 years as a nurse, saved diligently in her 401k, and now lives off her investments. A few years ago, her portfolio, heavily weighted towards bonds and dividend-paying stocks, provided a comfortable and predictable income. But then inflation began to run at 5%, 6%, or even higher, while her safe bond portfolio was yielding 3 to 4%. In real terms, she was losing purchasing power every single day. Her savings were melting away like an ice cube on a summer sidewalk. To make matters worse, as the Fed raised interest rates to fight inflation, the principal value of her existing bonds plummeted. She was trapped. This is the predicament facing tens of millions of American retirees and savers. Their traditional safe havens have become sources of loss, and so they are forced to look for alternatives. The surge in the gold price is, for many, a lifeline. People like Jane are now, for the first time, seriously considering an allocation to gold, not as a speculation, but as a desperate act of wealth preservation. They are visiting local coin shops, which are experiencing a boom not seen in decades. They are calling financial advisors and demanding to know why precious metals aren't a bigger part of their strategy. This has spawned a massive and not always scrupulous industry. The airwaves are flooded with advertisements from gold IRA companies, promising to help people convert their 401ks and IRAs into accounts that can hold physical gold and silver coins. While legitimate for some, this process is often fraught with high fees, wide bid-ask spreads, and aggressive sales tactics that prey on the fears of the elderly and financially unsophisticated. The ripple effect, therefore, is not just economic, it's social. It creates a new landscape of opportunity and vulnerability for American families trying to navigate a treacherous financial world. The second major ripple effect is on American industry and employment. While the U.S. is not the world's largest gold producer, that title belongs to China, Australia, and Russia, it has a significant mining industry, particularly in states like Nevada, Alaska, and Colorado. The surge in gold prices acts as a massive stimulus for these regions. A mine that was barely profitable at $1,800 gold becomes a cash-gushing machine at $2,500 gold. This leads to a cascade of economic activity. Mining companies, flush with cash, begin to invest heavily. They hire more workers, geologists, engineers, heavy equipment operators, and support staff, offering high wages that ripple through the local economy. They buy new, multi-million-dollar haul trucks and excavators from companies like Caterpillar, boosting manufacturing. They expand existing mines and, most importantly, begin to explore and develop new projects that were economically unviable at lower prices. This can revitalize entire towns, bringing jobs and prosperity to rural areas that may have been struggling. The story of a gold rush is a classic American tale, and we are seeing modern versions of it play out in the mountains of the West. However, this boom also has a downside. Gold mining is an energy-intensive and environmentally challenging industry. The push to fast-track new projects often leads to contentious battles with environmental groups and local communities over land use, water rights, and the potential for pollution from mining byproducts like cyanide. The rising price of gold, therefore, intensifies the age-old American conflict between economic development and environmental preservation. The third, and more subtle, ripple is on the US dollar itself, both at home and abroad. Domestically, the rising gold price is a constant visible report card on the management of the nation's currency. It's a barometer of trust. When gold is soaring, which signals a deep and growing lack of confidence in the future purchasing power of the dollar. This can become a self-fulfilling prophecy. If people believe their dollars will be worth less tomorrow, they will be more inclined to spend them today or exchange them for hard assets, which can further fuel inflation. It combines the timeless value proposition of gold with the efficiency of modern technology. This also brings gold into the conversation for younger generations, who may be more comfortable with digital assets than with physical coins. They can now buy gold on their smartphone apps, stored in vaults in Zurich or Singapore, free from the high fees and custody issues of traditional methods. This technological evolution is expanding the base of gold ownership, democratizing access to the world's ultimate safe haven asset and ensuring its relevance in the digital age. The ripples of the Golden Awakening are therefore vast and varied. They are felt in the retirement accounts of nurses in Arizona, in the mining towns of Nevada, in the halls of Congress, and in the fintech startups of Silicon Valley. The giant's rise is not a remote financial event. It is a force that is actively reshaping the economic realities and choices for millions of Americans, signaling the end of one financial era and the turbulent dawn of another. The giant is now fully awake. He has shattered the chains of the paper markets, his roar is the sound of new all-time highs echoing on the news, and his footsteps are the seismic shifts in the global economic order. The world has been irrevocably changed. The crucial question for every American, from the sophisticated investor to the young family just starting out, is no longer if gold is relevant, but what comes next. What is the endgame? How does one navigate this new world where the old financial certainties have evaporated and the barbarous relic now sits at the center of the monetary stage? Predicting the exact peak of any market is a fool's errand. The final phase of a super spike, the blow off top, is often driven by pure emotion and can reach levels that seem insane in retrospect. Could gold hit $3,000? $5,000? Mathematical models based on historical monetary relationships, such as the gold price required to back the US money supply, suggest that even five-figure numbers are not out of the realm of possibility in a true currency crisis. But focusing on a specific price target misses the point. The endgame is not about a number, it's about a fundamental reordering. The first plausible endgame is a monetary reset. This is the scenario that the world's central banks, particularly those in the East, seem to be preparing for. As trust in fiat currencies collapses under the weight of insurmountable debt and persistent inflation, there will be a call for a new international monetary conference, a modern-day Bretton Woods. In such a conference, the world's major economic powers would come together to design a new, more stable system. In this scenario, gold would almost certainly play a central role. It might not be a return to a classical gold standard where currencies are directly convertible into gold at a fixed price. It could be a more subtle system. Perhaps a new neutral settlement asset for international trade will be created, backed by a basket of currencies, commodities, and a significant portion of gold. The nations with the largest official gold reserves, the United States, Germany, Italy, France, Russia, China, would have the most powerful seats at this negotiating table. The decades of quiet accumulation by China and Russia would be revealed for what it was, a strategic masterstroke to ensure their prominence in the post-dollar world. The price of gold would have to be officially revalued dramatically higher to provide enough liquidity to backstop the global financial system. This would be a controlled, top-down repricing that would instantly enrich the nations and individuals who hold the metal. The second, and more chaotic, endgame is a disorderly unraveling. In this scenario, there is no grand conference, no orderly reset. Instead, the current US dollar-based system simply breaks down under its own weight. It could be triggered by a failed treasury auction, where the US government finds there are not enough buyers for its new debt, leading to a spike in interest rates that collapses the economy. Or it could be triggered by a hyperinflationary spiral, where the Fed loses all credibility and the public loses all faith in the dollar. In this environment, it's every man and every nation for themselves. The paper price of gold on the COMEX would become completely irrelevant, a historical footnote. The market would fracture into regional physical markets where the real price discovery would happen. Gold would not just be an investment, it would become money again. People would use it for barter and trade, a desperate measure to preserve wealth in the face of a worthless currency. This is the Mad Max scenario that gold bugs have warned about for decades. While extreme, elements of this are already visible in countries that have experienced currency collapse like Venezuela, Argentina, and Lebanon, where US dollars, and increasingly gold, are the only trusted forms of money. For the individual, physical gold and silver held in one's own possession would be the ultimate form of financial insurance, a bridge to whatever new system emerges from the ashes. The third, and perhaps most likely, endgame is a hybrid coexistence. The world may not be ready for complete abandonment of the fiat system, nor must it necessarily collapse into chaos. Instead, we may evolve into a hybrid system where fiat currencies like the dollar continue to exist for daily transactions, but gold is re-established as the ultimate bedrock of the system, the final store of value and Tier 1 asset for savings and reserves. In this new world, gold would be a mandatory and significant part of any truly diversified portfolio. A 1-0-2-0% allocation would become the new norm, not the 1-3% of the past. Financial advisors would treat it with the same seriousness as they do stocks and bonds. This sustained investment demand from individuals, pension funds, and sovereign wealth funds alike would put a permanent high floor under the price. The wild volatility might subside, and gold would find a new, much higher equilibrium level, fluctuating not based on speculative whims, but on real-world inflation and geopolitical risk. Technology would make it easy to save and transact in gold-backed digital currencies, creating a parallel financial system that acts as a constant check on the profligacy of governments. The dollar might remain the primary currency within the US, but gold would be the global, neutral money that disciplines it. So, how does the average American navigate these potential futures? First, education is paramount. Understand why gold is moving. It's not about getting rich quick. It's about understanding the erosion of purchasing power, the dynamics of global debt, and the weaponization of currency. This knowledge protects you from both the panic of a market crash and the euphoria of a speculative bubble. Second, distinguish between gold the investment and gold the insurance. Paper gold instruments like ETFs and futures can be excellent tools for trading and capturing short-term price movements. But they are not the same as physical gold held outside the banking system. For the insurance portion of your allocation, the part meant to protect you against a systemic crisis, physical ownership is the only choice. This follows the old adage, if you don't hold it, you don't own it. Third, avoid FOMO, fear of missing out. The worst time to buy any asset is when it's the subject of breathless, front-page news. A prudent strategy is to accumulate a position over time, a practice known as dollar-cost averaging. This smooths out the volatility and prevents you from going all in at the top of a speculative frenzy. A position should be built patiently with a long-term perspective. Finally, recognize that gold is not a panacea, it is a barometer. The soaring price of gold is not the cause of our economic problems, it is a symptom. It is a signal of deep structural issues in our financial system. The ultimate solution is not just to own gold, but to push for fiscal and monetary discipline from our leaders. A return to sound money principles, balanced budgets, and a focus on productive growth is the only way to truly secure the nation's economic future. The golden giant has awakened not as a monster to be feared, but as a messenger, a powerful ancient voice warning us that the path we are on is unsustainable. He offers not a prediction of doom, but a chance for preservation. He's a reminder that true wealth is not an illusion of digital promises, but something real, something tangible, something that endures. The end game of this golden saga will not be written by the traders on Wall Street, but by the choices we make as individuals and as a society in response to his thunderous wake-up call. The new golden world is here. Navigating it will require a return to the old virtues of prudence, foresight, and an appreciation for lasting value.